Hello and welcome to the very first episode of the brand new podcast here at Stockopedia. This is a very new venture for us. This is something we've not done in-house before. So I will say up front that we are really keen to get your feedback, your comments, your suggestions. There is a link in the episode description, so wherever you are listening, to a very short survey. If you could go and fill that out once you've listened to this episode today, that would be very much appreciated. It really helps us improve and make the podcast as valuable and as useful for you as possible. There are three parts to this episode. We're going to start by reviewing the week's key headlines and hopefully go underneath the headlines a little bit to uncover some of the key investing lessons that we can learn from those. In part two, we're going to talk a little bit about an article our CEO, Ed, wrote on Stockopedia this week about the phrase ahead of expectations in trading updates. We're going to dig a little deeper into that and see what we can learn. And in the final part, we're going to pick a winner of the week, and then we're going to look ahead to next week's economic announcements and company updates to give you a little sneak preview of what you can expect from the week ahead. My name's Lawrence. I'm the host of today's episode. I'm joined today by two of our analyst teams here at Stockopedia. Graham Neary, hello.
Hello, how are you doing?
I'm very well, thank you. How are you?
Yeah, I'm fine, thanks.
And I'm also joined by Roland Head. Hi, Roland.
Hi, Lawrence. Hi, Graham.
Just before we get started, very quick little disclaimer. None of this is financial advice or a recommendation. Obviously, stocks can go down as well as up. It is important you do your own research. Graham and Roland and me, we may own shares in some of the companies that we discuss. Where we do, we are going to disclose that just for the sake of transparency. We may also chat through some other content or some other resources that we've published on Stockopedia. If we do, I'm going to include a link to it in the show notes so you can go and check that out and browse around some of the other content. So with that all said and done, let's move on to part one. So this week we had a decent bit of macroeconomic data come in, didn't we, Graham? We had some US inflation data that came in as expected. The UK economy apparently shrank for a second month in a row. That was just announced. And European Central Bank interest rates were cut by a quarter basis point as expected. Graham, what stood out to you this week? Was there anything in particular that stood out among this week's macro announcements?
Well, I suppose it's just highlighting the different conditions when you compare the UK with the Eurozone and with the United States. We've got a very clear rate cutting trend in the Eurozone. In the US, inflation still not perfect, a little bit higher than desired, but it seems that the Federal Reserve is likely to still cut rates a little bit. They're still quite high there, about 4.5%, but probably going to see another cut there, and then maybe that will be flat for a while. And then in the UK, we've got higher rates and not much hope of change there for people who want to see rate cuts because the economy is still a little bit weak. And so on that basis, things look like they'll stay on hold at 4.75%. So a little bit of weakness in the UK economy. The US remains extremely strong, even at higher rates than it had before. And the Eurozone, perhaps unsurprisingly, is the most keen to cut rates. So more of the same, and just highlighting the different economic conditions across the different regions.
Yeah, you mentioned strength in the US. On that front, I was really interested to see Google announcing this week their new quantum computing chip that they are calling Willow. And whenever I look at Alphabet's stock report on Stockopedia or any of the other Magnificent Seven, I have to keep readjusting my brain when it comes to the numbers that are on display there. With Google, we're talking a market cap in the trillions, $100 billion of operating profit over the last trailing 12-month period, which is a mind-boggling sum of money. Obviously, all of these companies are starting to. They stretch the limits of valuation and have done it throughout the last few years. But it seems to me that these companies, especially with their really high quality metrics, every time they start to look really way too expensive, they come out with an announcement about how their R&D and their innovation departments have just created new value and unlocked new value. I'm really keen to get your two reactions to that, because something that really stood out to me looking at the headlines this week.
I don't have a lot of understanding of quantum computing, but I think one thing that strikes me that's interesting about this and some of and say Amazon as well is the way that Google is becoming. It almost looks like they're becoming more and more vertically integrated. They're designing their own chips. Amazon has its own AI chip that they see as a competitor to Nvidia. They, in areas like power supply and data centers, they more and more they their intellectual property and their own in-house assets, if you like, are in use rather than outsourcing these areas of the business, which might have been the case in the past. I think it's partly just a function of how big they are, but maybe also just a reversal of a trend, really, that for things to be as kind of not fragmented, but for companies to focus on their core activity and to not own so many of the supporting functions as they once did. So and this just seems another step in that direction for Google.
Graham, what's your take on it?
Yeah, so I am a former shareholder in Alphabet. I did have to sell it. I think it was earlier this year I sold it, but I wrote an article on Stockopedia in 2020, which had the headline, "Just Google it. Alphabet is the most powerful collection of monopolies ever assembled." And I just outlined in that article how Alphabet was so powerful in so many different important areas with market shares that were extraordinary. I've gone through a phase in my investing life where I really focused on market share, and Alphabet was just amazing in, you think about YouTube, Maps, Gmail. I mean, any one of these things would be incredibly valuable in its own right. The Android operating system. Um, so on the quantum computing chip, I don't have any particular opinion, but I do love Alphabet, and maybe I will own it again in the future on a stock specific basis. But it's trading at over 20 times earnings now. It may well be worth. Maybe that might well be good value. I'm not sure.
One company that is absolutely not trading on a PE multiple that high is next on the agenda, and that is Boohoo, who this week announced a string of updates about Frasers Group and Mike Ashley's involvement or potential involvement on their board. Earlier in the week, the ISS, the Institutional Shareholder Services, sided with the Boohoo board and recommended that holders vote against board change to allow Mike Ashley or Frasers to join the board. Today, the company announced that they are willing to offer Frasers one board seat, but not to Mike Ashley himself or his quote-unquote insolvency expert. So I guess my question here is, how did we get here? I look at the share price history for Boohoo, and it's now worth about 10% of what it was in 2020. Obviously, we saw huge inflation of share prices during the pandemic, but how did we get here?
Well, I suppose if I was to start this topic off, I'd say Boohoo is really a company that succeeded because it won a price war. It competed on price, and that's how it took market share. And when it was no longer so competitive on price, it its profits essentially disappeared. And that's a very simple way of putting it. But a competitive advantage that's based on price, um, that may not be a permanent thing. Where is the price advantage coming from? Is it coming from facilities where people are working in very difficult conditions? How long can that last for? If it's possible for other companies to do the same thing from different locations. I mean, in simple terms, I would say that is a summary. In terms of Fraser's, um, I'm not a huge fan of the Fraser's or Mike Ashley strategy. It's very confrontational, and the it's not just ISS, but Glass Lewis have now also sided with the Boohoo board against Fraser's. So I'm not sure who's going to win that battle, but Mike Ashley is seen as a competitor, or at least as somebody with potential conflicts of interest by Boohoo. So I can understand their reluctance. They may see him as some kind of a vulture taking advantage of their weakness. But personally, I wouldn't be touching Boohoo shares regardless of who's on the board right now.
Yeah, I did write in my notes for this episode, is this Mike Ashley swooping in on what he thinks is yet another failed brand that he can revive and flog in Sports Direct? Is there any sort of bull case left for Boohoo?
I mean, I struggle to find one.
Roland?
I think to me from from my perspective outside the business, it seems like it could be 50-50. It might be that there is some value left and that they can regain some of the following they've lost. But as Graham says, the original runaway success was built on very low prices and very quick delivery of new designs, and now there are other bigger companies doing that at more competitively. So it's not clear to me. I wouldn't. It looks a bit speculative to me. I'm not sure that I would put any money into Boohoo either.
One company that had money pulled out of it this week was Dominos, who released earlier in the week an inline trading update. They also announced their new strategy, which involves an incremental increase in spending on advertising and e-commerce development, and asking for more patient timelines for new stores to hit targets. The market reaction, certainly this week, looks to have been quite negative. Closed at 340p on Monday. I then had a brief look at it yesterday, and it was down to around 306. So that's a pretty sharp drop over a few days. Domino's itself, according to its stock report and our stock ranks, high quality, fairly priced with moderate momentum. My read on this is that the strategy seems to be trying to thread the needle between growth, keeping its franchisees happy, who are obviously key to its expansion, rolling out new stores, and then maintaining profitability, which to me seems fairly sensible. Why do you think the market reaction was so negative to this?
Yeah, I think that's right. Domino's always has to maintain this balance. It's under pressure to increase the number of stores it has, ultimately from the master franchisee, the parent company in the US, Domino's Pizza. But at the same time, it's had problems, or the relationship with franchisees hasn't been entirely smooth sailing in recent years. I think they felt they were under pressure to expand, but not necessarily getting a fair slice of the proceeds. And the challenge Domino's faces, I think, underlying all of this in the UK is that there aren't that many places left without a Domino's store. So the company has about 1,400 at the moment, which is very similar to McDonald's, but they want to increase this to about 2,000 by 2033, which coincidentally is roughly the number of stores Greggs has at the moment. So to do that, Domino's is having to split some of its existing franchise territories into two, and it's kind of intuitively obvious that running two profitable stores in the same area that used to have one is going to require an increase in sales and maybe going to put some pressure on costs. So I think that's the background to it. Domino's, as you say, they've agreed a new package, a new framework that will see spending on marketing and technology bumped up a bit. And I think really the negative reaction this week is just a feeling that the market is guessing that Domino's growth is going to be a little bit slower than maybe was previously hoped for. For example, I think one telling point is that the financial incentives that are paid to franchisees for opening new stores, they were previously paid over 3 years, but now the same payment is going to be spread over 5 years. And as an indicator of how hard dealing with opening stores in split territories is, the payments the franchisees receive for that are 150,000, so 50% higher than the 100,000 payment for opening a store in a virgin territory. So really, I think it's just the idea that costs are going to be a little bit higher, growth maybe a little bit slower, and so there's no need to maybe push the share price as high as it has been in the past. But as you say, I think it remains a good business, a strong brand. I don't see any existential concerns here. It's really just a question of pace of growth and maybe a little bit of pressure on profitability.
There is, after all, only so much pizza that the UK can eat.
Yeah, I mean, the key underlying all of this, the key is that they have to try and find a way of making people order more often, more customers, but also more frequent purchases. And it's not necessarily easy, especially as Graham said, the UK economy is a little bit sluggish and consumer spending is still under pressure.
I remember seeing a comment from, I believe it was somebody within Domino's management, that they are actually a sauce company that also happens to sell pizza.
Yeah, I mean, I probably should have mentioned that. Really, what it is that the franchisees have to buy all their ingredients and I think probably all of their consumable supplies from Domino's, and that's about 70% of Domino's revenue each year, and a fair portion of its profits too. So the franchisees have to do the heavy financial lifting of opening the stores, recruiting staff, and so on, and they have to buy all their supplies from the parent company. So they don't have much control over costs, and so it's easy to see why some franchisees may have felt a little bit squeezed at points in the past, while Domino's has been trying to protect its profits. So yeah, it's a good description. Yeah.
I just feel like it tracks quite well with mine and my wife's buying behaviour, where we'll order Domino's every so often, but every order we will stock up on their garlic and herb sauce pots. We will have those with supermarket pizza. So maybe that's something that Domino's needs to lean into. Graham, we're going to shift now entirely to the other end of the market cap spectrum to chat about a tiny £30 million marketing agency called Brave Bison. I wanted to chat through this with you this week because it struck up an acquisition deal with a company called Engage Digital Partners Limited, who are another marketing company, a global sports one, links to Formula One, cricket, Real Madrid, New Zealand Rugby, the All Blacks. You said in the Daily Stock Market Report this week when you wrote about it that this was an acquisition deal that made a lot of sense to you, and you were impressed by how they protected themselves against the deal going against them. I will say that the update itself, the RNS they issued, was full of words I couldn't understand, frankly. It was quite technical, so I wondered if you were able to help me understand in more simple terms the structure of the deal.
Yeah, absolutely. And I think there are broader lessons that can be drawn from this story. So the main point here is that the deal they announced could cost up to £10.6 million. However, there's only £2.1 million being paid up front in terms of enterprise value. So that's what they're paying for the business on day one. And the rest of it is in the form of warrants, which are basically options over Brave Bison's own shares, and a large uh, contingent consideration, which is subject to performance. Now, I didn't see those performance conditions explicitly spelled out, but generally, what I look for in these types of deals is where the the deal can sort of pay for itself, at least to some extent, if things go well in the subsequent years. And I think that's basically what we're looking at here. So the warrants, for example, are £2 million, and they're on the Brave Bison share price itself, and they can't be exercised yet. Um, so, the Brave Bison as a whole and the acquired company will both have to do reasonably well in order for all of this money to be paid. And I just think it's the type of deal that I like, where the deal might pay for itself. There's a lot of conditions attached. I mean, if I was to draw an analogy, it would be as if you were looking at Premier League footballers who only got paid their normal salary if they played well every week. That's sort of what we're looking at here. The sellers of this company will do well if the company itself has, and Brave Bison as a whole, does well. So, in general, when I look for companies doing, M&A, I like companies that wait patiently for the companies they're looking to buy to go into administration. So I own shares in Next. Next is very good at that. Um, I also own shares in a small turnaround company called Volvery. That's only a tiny little company, but historically that was very good at buying companies out of administration. I don't like seeing deals where people are coming in and paying full price without many conditions attached. So I think this example we're talking about this week is a good example.
Yes, thank you for the Premier League football analogies. I tend to get along quite well with those, so more of those, please. So moving on to Serica Energy. It's a £500 million market cap oil and gas company. Announced this week that they were making an acquisition of assets from Parkmead Group. Roland, what does this deal allow them to do?
Yeah, so it's a relatively small purchase up front. The committed expenditure is only about 14 million, although potentially there's a bit more in the future. But what this gives Serica really is kind of option value on a couple of oil fields in the North Sea, where in one case the company already has an interest and will now become the controlling operator, whereas before it was a minority uh, investor in the field. So it's really option value. Serica has been working as a consolidator in the North Sea, buying up mature fields and using its infrastructure to run them for cash, effectively producing as much oil and only spending money where they're quite confident they'll be able to get it back in fairly quickly from new production. So this is just another increment really in that strategy, I think, and it comes with some attractive um, tax losses embedded in as well.
I guess that was the next question running through my head as you were talking there.
Sorry.
A lot of the questions that investors have about UK oil and gas companies at the moment is how are they going to offset some of the windfall tax that the UK government is levying on them? Does this deal allow Serica to do that?
I think it does to some extent. It's always a little bit hard to be sure because there's several different types of tax and several different, activities that may be charged against it. But the deal apparently comes with 197 million pounds of ring fence corporation tax losses, 181 million of supplementary charge tax losses, which is an industry tax that was already in existence, but I think has just increased slightly. And then a small amount of energy profits levy losses, which was the windfall tax introduced um, uh, just a couple of years ago. So I imagine overall there'll be some tax benefit if Serica chooses to spend money developing these projects further as well, and that's definitely an additional value for Serica Shell.
Great. Thank you, Roland. I know you've got to go now, so thank you very much for your contributions today. Graham, moving on to S3, ticker STEM, the specialist scientific sector recruiter. They took a real chainsaw to their profit forecasts this week. I remember looking at their stock report a few years ago and getting quite excited initially. They seem to have really good quality metrics, great value metrics. At the time, I think they still do, especially off the back of this profit warning. But I zoomed out and looked at a 10-year price chart, and outside of a pandemic spike, it looks like a really cyclical company. The price trades within a really well-defined channel, I think it's called. Is this common amongst recruiters, or is this cyclicality specific to S3?
Yes, I mean, the recruitment sector is a very tricky one, and I generally don't uh, take a positive stance on recruitment companies because, in general, I would say that they are not the greatest sector to be involved in. Um, I've sort of made an exception for S3 because its performance over so many years had been so consistent. Unfortunately, they are no longer consistent. They've had to publish this enormous profit warning. Um, one interesting feature of the profit warning is that it's for the financial year November 2025. So the year that's only just begun. I suppose if I was, because I kind of do have a soft spot for the company. I don't own shares in it, but I've kind of been a fan of the company for a while. I do think that we can admire the fact that they've cut their forecasts so much so fast with the financial year only just begun. Um, Another feature of it is that they announced a buyback at the very same time. And that's another kind of rare event that you see a buyback and a profit warning simultaneously. But it's a cash rich company, and that's one of the reasons I've been a fan of theirs. I did get a chance to speak to management this year. They explained to me that they did need quite a lot of cash just to fund the business and to fund their expected growth. Um, but at least they're willing to use their own cash to do that rather than borrow, and they've got a surplus. This is one of those businesses where if they're not growing, they need less cash. So there's £20 million being directed towards a buyback now. So I'm I'm still fairly positive on this one, but I think the big problem probably is economic weakness in Europe, where they have very large portion of their operations. They are an international business, but very heavy in Europe. And so, kind of going back to what we were saying about the ECB and the Eurozone, um, maybe things are pretty tough in Europe, even worse, even more difficult than in the UK in terms of the broader economy, and maybe that's the reason. Recruitment is very very sensitive to business sentiment. So even when the economy might not seem that weak, if businesses are a little nervous, that seems to really hammer the performance at recruitment companies. So it's a tricky one. I still have a broadly positive view on management and the business, but it is a tough period now.
So when I saw this news, my mind, whenever I see a profit warning, probably because I work at Stockopedia, I always think of, we have something called the Profit Warning Survival Guide, which is, I'm going to link in the show notes. It's a really great piece of research that our team did a few years back into what happens before, on the day of, and after a profit warning. And one of the real standout lessons for me from that was that high quality companies tend to make better recoveries after a profit warning, far more so than lower quality companies do. Obviously, as we touched on, S3 has really great quality metrics. What do you see as being critical to S3's recovery from this profit warning?
Well, I suppose it's probably just the focus on their bread and butter. Their bread and butter is scientific or STEM recruitment for contract positions. And that has insulated them from a lot of the damage suffered by other recruitment companies, which focused on permanent recruitment, which is much more volatile, or other sectors. STEM tends to be a pretty solid place in the recruitment world. So, I mean, if they just stick to their knitting, um, they've got a technology improvement program. They say that they're very modern. I believe that they have very modern systems. So I guess that's it. If these economic conditions are the root cause, and if those root cause conditions are temporary, then we can look forward to a rebound. But of course, nobody knows for sure. Some people might argue that there's been a permanent shift and that recruitment will be less profitable going forward permanently. That's a bet that you or that's a risk that you face.
Thank you. That makes a lot of sense. Finally, in part one, we are going to talk about Impax as an asset manager, £430 million ish market cap, who today announced some bad news that they were losing a mandate to manage one of the St. James's Place funds. This represented about 14% of their total assets under management and about 7.5% of their total revenue. This is, I think, not that they reveal this, but this seems to be in response to some pretty major criticisms publicly of how St. James's Place has done business. St. James's Place is now cutting costs and removing mandates from external asset managers. Obviously, this now means that Impax itself doesn't have any more exposure to St. James's Place. This was one of their last funds. This was, the last of their funds they were managing. Their share price has not done very well recently at all. It's been a pretty persistent downtrend for a while. What would the potential catalysts be for a reversal in fortunes for an asset manager like Impax?
Yeah, so most fund managers, as listeners will I'm sure be aware, most fund managers have been suffering outflows. I know there's very few exceptions to the rule, and Impax is struggling now in terms of flows. And this news is, a single one-off major blow to AUM and to their flows. Uh, I mean, the good news is that it's a very specific situation. St. James's Place has received terrible media coverage in relation to its fees and the transparency of fees that it charges customers. Now, I don't have a strong view on that. Obviously, I'm a self-directed investor, so St. James's Place is catering to to people who need more help with their investments. Um, but this is a very specific situation where St. James's Place had to make some big changes, probably not just for the public perception, but also because they probably were, they probably had made some mistakes in terms of how they had decided to allocate money. Um, but the Impax fund that's being sort of switched away from Impax, it did underperform its peers, but I don't think the underperformance is huge. I think it's a few percentage points. So ordinarily, I don't think that Impax would have lost this mandate. Um, I think performance probably is a reason, but I think there's an institutional imperative at St James's Place to make changes, and I think that's the real reason here. Um, so looking forward, if this is just a one-off event, I think Impax is going to go back to being a company that's probably suffering outflows like most of its peers, but where valuation is very cheap compared to the past. So it's down by more than 80% from its peak. Now, unfortunately, I did turn positive on Impax at 710p or something. It's now 264, so I was way too early. But it was substantially higher than that. I think it was nearly £15 at the peak. So it just goes to show how these valuations can go crazy. I think they overshoot to the positive. I think they overshoot to the negative. And personally, I'm inclined to think that Impax has overshot to the negative now, but I could be completely wrong on that point. Time will tell, but I do like the valuation here. And I don't own shares in it, but I'm certainly thinking about opening a position in this one now.
Yeah, certainly tempting when you think something has overshot to the negative. That's all we've got time for in part one. We'll be back after a very, very short break to chat about the phrase ahead of expectations and a little bit of Games Workshop. Welcome back to part two. In this part, we're going to chat about an article that our CEO Ed Croft posted on the site earlier this week called, and I quote, "Ahead of Expectations, the three most powerful words in investing." And now, within that, he referenced Games Workshop as a case study. Now, Games Workshop has had an excellent number of years, but this week it announced that it had not only finalised its deal with Amazon to produce television series and other media ventures around the Warhammer 40,000 IP, but it also joined the FTSE 100. So overall, it's had a pretty good week. But the reason it was included in this article is because its meteoric rise in share price. Share price has increased 27 times since it first published a trading update containing the words ahead of expectations. And if you have followed the work we've done quite recently on multi-baggers in the last year or so, you'll know that this was quite a common trait among the top performing shares over the 10-year period of the study. They delivered a string of these ahead of expectations announcements. So it's safe to say that the market's kind of become conditioned to these consistent beating for forecasts, these ahead of expectations announcements, these earnings surprises. For stocks like this, I guess my question when I look at shares like this is what sort of growth and what sort of upside tends to be priced in for stocks like this already?
Yeah, so I think most investors managing the largest sums of money are either passive or they are active with a time frame of maybe 2 years. So these fund managers are, if they are doing independent research, which not all of them are, but if they are, then they are looking to basically predict upside surprises. So I think that for say the average private investor trying to get ahead, I think there's just a lot to be said for understanding a business and understanding why a business is good, fundamentally a good business. And that, I think, can lead to great performance over a time frame that's much longer than 2 years. Games Workshop, that's another share that I've held before. I held it a couple of years ago. I think I had a decent return if I remember correctly, but then I sold it. Um, it is an example of a company where I would say it is simply unique. It makes a unique product. If you were to say what is the market share for tabletop wargame figurines, Games Workshop would be doing pretty well. I don't think there's many competitors in the space. I think at one point I was trying to find competitors and I couldn't really find any direct competitors. I suppose there's, if you make it a slightly broader space, you could include other types of board game uh, as a potential competitor. But then I think there's always probably going to be that niche of people who want tabletop figurines. There's something cool about them. I never got into it myself, but I had friends who did growing up, and I was impressed. I could understand the attraction. So if that niche is always going to exist, and if Games Workshop is the undisputed number one with basically no competition, then I think you've got a good recipe there for strong returns straight off the bat. Um, you've got intellectual property. Uh, in some ways, you could look at Games Workshop as an answer to Disney. Obviously on a tiny scale, but it's got that intellectual property that's unique, that it owns, that it can license, and you've also got management who are very shareholder oriented. So Kevin Roundtree has been delivering cash to shareholders. He's clearly very focused on how much cash he can provide for shareholders, running the business for cash, but also for growth. Um, People who've been watching the stock for a long time will know that it's a little bit eccentric in how it does things. I like that personally. I like companies that are willing to do things their own way, making totally irregular, unpredictable dividend announcements that are at the same time delightful for shareholders. And the intellectual property just seems to get more and more valuable. So it's an absolute winner in that regard. Uh, I'm not in any rush to own the shares. I don't know if I'd be outright green on them today, or if you have to take the valuation into account. It's obviously going to be highly rated at this stage, but I'm glad that it's in the FTSE 100 because I think the FTSE 100 needs more quality companies, and this is a good example of one of them.
I thoroughly enjoy the idea of Games Workshop unlocking a new stream of revenue through Games Workshop World theme
Why
parks all
not?
around the world. I think it's a fantastic idea. I also noticed that there's a massive secondary market for their figurines. People are taking them, they are painting them, and then they're selling them on at an even bigger price. It's quite staggering. How do you find other stocks like this? I mean, where this is probably the $1 million question. But how do you find other stocks like this, which are kind of boring, but somehow just keep continually beating their expectations time after time after time?
Well, I don't claim to be an oracle of earnings surprises, but for the reasons I outlined in relation to Games Workshop, it is a unique company with unique strengths. If you're in companies where there's a lot more competition, then wins tend to be temporary, as we've discussed with other companies in this podcast. So I think repeat ahead of expectations. There has to be something special going on. It could be a permanent competitive advantage. Um, it could also be, and I suppose this is something we need to be careful of. It could be earnings management where forecasts might be deliberately kept conservative so that they can be beaten. I do think some companies probably do that. It's not really a bad thing, but just something to be aware of. The whole thing is a bit of a game between between companies and brokers, where earnings can be set, where kind of wherever the company really wants. So do need to be careful of that. Um, and Yeah, I think that's sort of the way I look at it. I don't know if I can give you any specific rules, but one observation I would make is that the efficient market hypothesis is completely out the window. I think Ed's article demolishes it very well. Um, the strong form of the efficient market hypothesis gives us a random walk, and turns out that it's not a random walk at all. And Ed's charts prove it.
If you are a subscriber to our stock market research platform, you will be able to read Ed's article if you've not done so already. I will link it in the show notes. We're going to take a very quick break, and then we're going to come back for part 3, in which we'll pick a winner of the week other than Games Workshop, and we're also going to look ahead to next week's news. Welcome back to part 3. We're going to kick this off with our winner of the week. My pick for this week, I wanted to include something other than Games Workshop. So we're actually going to talk about one of our customers, one of our subscribers. I spotted a comment from him earlier this week. He was explaining his investment process, and I wanted to just shine a light on it. For context, he was shouted out by our editorial team because he'd got in touch to say that his SIP, his self-invested personal pension, was up 82% year to date, which is obviously a phenomenal return. So I just wanted to call out his process because it's incredibly systematic. And Graham, I wanted to get your take on it. So his process is he takes his total portfolio equity value, he divides it by 10 to get a position size per stock. He then runs some screens to find potential candidates that are both high quality and high momentum using our stock ranks. These can be in the EU, the UK, or the US. He also looks for ones that have increasing broker estimates for the current and next year. And then he selects his preferred candidates. He wants stocks that are currently in an uptrend and that are either close to or currently setting new highs recently. As he says, winners keep winning. He buys the stocks in GBP, and this is the bit that stood out to me because he says, I do no company research beyond the output of the screening process. And he repeats that in the comment because he says it makes a lot of people who think you need company and or business knowledge to invest a little bit unsettled. He sells stocks if they release bad news, if the share price drops unexpectedly without a wider market pullback, or if the share price stalls for an extended period, or if its quality or momentum falls. He says he doesn't care about exchange rates. In fact, by owning stocks in multiple currencies, he thinks he's spreading the risks. He says he knows he will lose some interest as a result of withholding tax, but he's more focused on capital growth than he is dividend income. Now, to me, this sounds like a huge win for systematic investing as an approach to the stock market. Graham, I'm curious, what, if any, do you see as the drawbacks to investing like this? Like, why doesn't everybody do this?
I mean, a simple answer would be that if there's a winning method, then it goes away as soon as lots of people are doing it. So there are many different ways to win, and this subscriber has found something that works, and long may it continue. Personally, I'm more of a value guy than a momentum guy, so QM candidates would probably make me nervous, but then he's got this method which which I guess is reallocating on a regular basis. So it's working because momentum does seem to be a real factor that does work in the stock market over, if you get your time frame right. So, I mean, if I was to try and be as negative as possible and find a problem, I would probably say that when you invest like this, you could potentially buy something that's just an outright fraud and that just disappears someday, which has happened, to some high profile companies that we've looked at, like Patisserie Valerie disappeared one day. The Chinese stocks disappeared one day. But at the same time, lots of people who do fundamental research get trapped by these things as well. So, you know, I'm really impressed that the subscribers got such good returns. Doesn't sound as if it costs them a huge deal of time, research time, or uh, calculation time. So, as I said, long may it continue.
Absolutely. I couldn't agree more. Looking forward to the week ahead. Our head of content, Megan Boxall, has published an article about this for our subscribers, including some extra analysis on some of the companies that are reporting next week. So if you're a subscriber, you can go and read that in the discussion section of our research platform. I have included a link to that in the show notes as well. Looking at the macro announcements next week, on Tuesday we've got the UK unemployment rate and the US announcing their retail sales data, which I believe does include the November and the Black Friday period. On Wednesday we've got UK inflation, the US Fed interest rate decision. A day later on Thursday we've got the Bank of England's interest rate decision. Friday we've got some more US inflation data as well as some UK retail sales data. I imagine that this does also cover the same period around November and Black Friday. Obviously, at the start of the podcast, we touched on Graham's thoughts as to the macro situation and what he anticipates happening next week. There's also a number of companies reporting. It is a little quiet. There's a lot of AGMs happening next week as companies wrap up for the calendar year. So next week we have picked out Tristel, Allergy Therapeutics, Chemring, Videndum, Integrafin, Beeks Financial Cloud, Dot Digital, Time Finance in the UK, and in the US, FedEx and Nike are two of the big ones reporting next week, all scheduled to issue updates. As I said, you can read more about those and some extra analysis that we've done in the article linked in the show notes. That's all we've got time for this week. Thank you so much for listening to this first episode. I really hope you enjoyed it. If you did, I'd love it if you could subscribe or follow wherever you are listening. And as I said at the beginning, we have a very short survey that's linked in the show notes to capture some of your feedback, some of your thoughts, what you liked, what you didn't like. We're very happy to hear both of those. Helps us improve and makes this podcast as good as we can make it for you. So please do take the time to go fill that out. Graham, thank you very much for your time. I really appreciate it. And thanks again to Roland, who joined us in part 1.
Thank you, Lawrence.
And we will see you at the same time next week. Bye for now.